Every week, two stocks hit new lows for reasons that aren't always obvious. In this series, we break down what's behind those moves so you understand what's actually driving the market. This week's list is especially interesting. It's small, which tells us the market is being selective. We're seeing well-known, high-quality names making new lows. Not because their businesses are falling apart, but because the market is changing how it prices growth, risk, and consumer behavior. So today, we'll break down Ferrari and Campbell Soup. If we understand why these two stocks are hitting new lows, we'll have a much better feel for what the market is worried about right now and what it might do next. Let's start with Ferrari. Ferrari is one of the strongest brands in the world. Not just in cars, in luxury, period. They don't sell transportation, they sell exclusivity, performance, and status. And they do it better than almost anyone else. What's interesting is why the stock is hitting a 52-week low. This isn't about demand collapsing or Ferrari losing its edge. Shipments are basically flat by design. Ferrari limits supply on purpose. Growth comes from charging more per car, not selling more cars. Ferrari justifies those price increases by constant upgrades in performance, technology, and customization. The issue here is expectations. The market went into earnings looking for continued fast, long-term growth. Instead, Ferrari management revised its growth targets and took a more conservative tone on EV adoption. At the same time, investors are growing uneasy about resale values for newer hybrid models. These have been weakening on the secondary market. That's raising a bigger question. Is Ferrari pushing electrification faster than its core customers actually want? That uncertainty is what caused investors to sell the stock. They're rethinking how much they should pay for this level of growth, even for a best-in-class business. And that makes Ferrari an interesting stock to learn from. From a financial standpoint, Ferrari actually had a strong quarter. Revenue grew about 7%, even though shipments were basically flat. That tells you everything you need to know about how this business works. Ferrari isn't growing by selling more cars. They're growing by selling more Ferrari with each car. The biggest driver of revenue was pricing and personalization. Customers are spending more on custom paint, interiors, and performance upgrades, all high-margin add-ons. That's pushing revenue per vehicle higher and expanding margins at the same time. Operating margins stayed strong, and cash flow remained solid. There's no balance sheet stress here, no demand collapse, no discounting. If anything, this still looks like a luxury goods company with massive pricing power. But here's where that disconnect comes in. While the numbers are good, they weren't exciting enough to justify the valuation Ferrari was trading at. Growth is still there, it's just slower, steadier, and more controlled than the market was hoping for. So financially, Ferrari did what Ferrari always does: protect the brand, protect margins, and grow carefully. The problem is, the market wanted speed. Ferrari delivered discipline. And in this market, discipline doesn't always get rewarded in the short term. Ferrari was growing fast, close to a 20% average net income growth, and that's what justified the premium valuation. Now, management is guiding to just 6 to 7% growth going forward. That's a major slowdown. Even if we're generous and assume 8% growth and add Ferrari's roughly 3% forward yield, you get about 11% total return. If the valuation multiple holds steady, that implies roughly a 69% return over 5 years, which would still underperform the broader market. And that's the optimistic case. If investors decide Ferrari should earn a market-level return and the forward PE re-rates closer to 15, the math flips completely. That scenario points to a roughly negative 23% return over the next 5 years. So, my take is simple. Avoid the stock for now. Either wait for the valuation to reset to a more attractive level, or wait for Ferrari to prove that growth isn't actually slowing. Ferrari's biggest risk is misunderstanding its customer. Based on buyer feedback And what we're seeing in the resale market, one thing is clear. Many Ferrari customers value nostalgia, manual gearboxes, naturally aspirated engines, and a more analog driving experience. Ferrari, on the other hand, thinks like a racing company. Their focus is performance at all costs, which naturally pushes them toward electrification and fast automated drivetrains. If that gap between what customers want and what Ferrari builds widens over time, demand and resale values could eventually suffer. The takeaway? Ferrari is a reminder that premium valuations demand premium growth. Even the best companies can be bad stocks if you pay too much. Next up, let's switch gears from luxury supercars to something a bit more everyday. Campbell's Soup, another 52-week low that tells us a lot about how the market is thinking right now. Campbell's is one of those brands everyone knows but most people don't think much about. For over a century, they've been a staple in pantries, snacks, and sauces. Recently, though, the company has been trying to reinvent itself with a new strategy it calls Set the Standard. The goal is simple: focus on premium, high-margin leadership brands like Rao's Italian sauce and broth, modernize the portfolio, and grow in a more predictable way. But the stock is still declining. Sales are soft, margins are under pressure, and tariffs are hitting the bottom line hard, around 4% of the cost of goods sold. Even with mitigation efforts, Campbell's can't fully offset these headwinds. Add in a competitive snack market and consumers who are more price conscious than ever, and you see why the business is struggling. This isn't a failing business, but it's a business under pressure, and that tension is exactly what makes Campbell's an interesting stock for investors to review. Financially, Campbell's is under real pressure. Their core categories, meals, beverages, and snacks, are shrinking or growing very slowly, and EPS has been declining. Tariffs, cost inflation, and supply chain issues are also eating into margins. It's not all bad. The company is focusing on premium, high-margin leadership brands like Rao's and Broth, which are performing well and driving more predictable growth. Consumers across all income brackets are increasingly seeking premium experiences, a trend we've highlighted repeatedly on the channel. Campbell's is cutting costs to restore margins, but revenue growth remains under pressure because it competes in many declining segments. Truth be told, with such minimal growth, the stock should have never traded above a 15 forward PE. Now that growth has stalled and Campbell's plans are uninspiring, the stock has re-rated. That raises a key question. How should we value this weaker company? When it comes to valuation, Campbell's trades at an 11.5 forward PE. This equates to an 8.7% forward yield, which sounds cheap until you remember there's zero growth. That means we are getting all of our return from yield. I would want a yield of 14% or about a 7 forward PE to account for potential slowdowns in growth. Plug that into our valuation model and we get a negative 8% return over 5 years. My take? Avoid this stock. It's only worth the risk if you can buy it at a massive discount. Campbell's biggest risk has already materialized. Changing consumer preferences have left the company with production lines of meals and snacks people no longer want. But it's worse than that. The company carries significant debt. This leaves it vulnerable to massive refinancing risk. One small issue and this house of cards collapses. The takeaway? Campbell shows why valuation matters. There was no reason for this stock to trade at a 15 to 20 forward PE, and now investors are paying the price. So what do Ferrari and Campbell's teach us this week? While they seem like completely different companies, both are facing a similar challenge: slowing growth driven by shifting consumer preferences. Ferrari clients are questioning the electrification transition, while Campbell's consumers are moving away from stale, boring food brands. The takeaway is clear. Forecasting growth incorrectly can lead to massive losses. Valuation matters, growth matters. Knowing how to analyze both is key to buying a stock at the right price. That's it for today, guys. If you found this helpful, hit like. And since you stuck around this long, join me on Discord. Link in the description. I really do want to talk to you. Thanks. Bye.